Hi everybody, welcome to our webinar. Come on in and make yourself comfortable. We'll get started in about 1 minute's time. Good afternoon everybody, come on in and make yourself comfortable. I'm just waiting for a few more people to join us and then we'll kick things off. All right, hope everybody's comfortable. Welcome to this webinar on how to create a portfolio to get through the next crash and protect your wealth. My name is Jeff Thurick. I'm a director of Evalesco and Australian Advice Network. And I'm very excited today to be joined by my friends and colleagues from AAN, Marshall and Hugh. Welcome along and thanks for joining us, guys.
Pleasure, Jeff.
So we're coming here from separate locations. Marshall and I are in our homes in lockdown in Sydney, and Hugh is fortunate to have a little bit more freedom and coming in to us from his office on the Gold Coast. We hope that wherever you are, you're doing well and enjoying the Olympics, enjoying your peace and quiet in lockdown, or enjoying going about everyday life. So just like to let you know, for today's webinar, you'll be on mute and your video is turned off, so we can't see or hear you. We do, though, encourage you to ask questions along the way. So you can do that by going down the bottom of your screen, clicking on the Q&A tab and typing in any questions you have there. And we'll endeavour to get to those on the way through. I'll be checking those and firing them off at Hugh and Marshall, or we might get to them at the end as well. Now, most of our conversation today will be about general investment strategies, broader economic environment and that sort of thing. So I'm going to provide you with a general advice disclaimer and let you know that what we're discussing today is general advice only. Even though most people on the webinar are clients of Australian Advice Network, we don't know your personal situation at the moment. So this webinar is not personal advice. If you'd like to discuss it further, then please contact your advisor or get in touch with Hugh, Marshall or I. So Marshall and Hugh are here today in their capacities as members of the AAN Investment Committee, and we're going to hear from them all about the AAN investment philosophy, how decisions are made on investments, how portfolios are currently positioned, and what that means for you. And obviously, as the topic says, how we're going to create a portfolio to get through the next crash and protect your wealth. So, gents, here we go. I'm going to start by, I guess, having a bit of a look back over the last 18 months or 2 years. So Marshall, starting with you, how have the AAN models performed over the last financial year and the last couple of years in general?
Thanks, Jeff. I guess for our audience, we currently run 6 models on the premium platform, and we're really happy with how those models have performed over the last 1 to 3 years in particular. And I guess I'd like to highlight, the performance of 2 particular models that many of our clients would have an exposure to. So across the AAN family of businesses, those clients that are younger will typically have a much higher allocation to what we call the AAN growth model. And, over the last 12 months, that's delivered outcomes of a little bit over 29% before fees, which is a really, really good outcome. And we know that because we track each of the models will have its own mandate and its own benchmark. So we track that. And it also has a peer group of, comparable funds that we track it against. So for comparison purposes, the peer group growth model has tracked at just over 20.1%. So that's a really big gap between how we've delivered outcomes and the peer group. Most of our retiree clients will have a smaller exposure to that, but they'll have a larger exposure to the balance model that we run called the AAN core model. And, over the 12 months, that's had a really great outcome as well. The numbers for that sit at 21.63, which I think is a really good number. And like the growth model, it's just on the back of really sensible management and adherence to our philosophy.
Fantastic. So some really good outcomes, both I guess in real numbers and in terms of comparing to benchmark and our peers. Hugh, handing over to you for a minute. What changes have been made to the AAN models in the last couple of years, and why were they made, and how do you think they've added value?
It's always good to touch on performance, but I think it's always about the inputs that deliver that, so that people can have peace of mind and confidence that their money's been managed in a professional manner. And I suppose the things that we did as a collective, which in hindsight were quite clever, was in March last year, when the portfolio fell down the COVID cliff, as we've been calling it. Markets went down drastically from February 24 to March 24. So as a collective group, we all got together and said, what are our options here to do? Our balance fund, our growth fund, have asset allocation, strategic allocations to growth assets and defensive assets. And obviously the growth asset component went down significantly during that month. And during that time, we all took in all the information, all the noise, all the information. We were looking at the World Health Organization website pretty much every day, going through, it's not a pandemic, not a pandemic, not a pandemic. Oh shoot, now it's a pandemic. So unprecedented amount of monetary and fiscal intervention. So from our point of view, we decided that we would stick to our knitting. Our research has always suggested that a quarterly rebalancing program works, and we stuck to our conviction on that. And turns out that was an enormous generator of extra return for our clients in a prudent manner. And in there, we also got expert guidance from some of the leading minds in our industry on hedging and what we should do with that. And so we're able to also protect our clients in that regard as well. So things like that protected us, and it can also give us confidence that the next time it happens, we're still going to be proactive. We certainly weren't reactive in that regard, whereas many other people were sort of being victims to what was happening in their portfolio management. We were able to take advantage of the problems that were emerging and make profits. So rather than panic, we made profits. So that's something that we as a group collectively did. And I think, Marsh, you might recall in December 18 what we did as well.
Yeah, we talk about rebalancing, and we do that on a quarterly basis, but really what that means is that at the end of the quarter, we look at those managers and assets that have done particularly well, and we trim those positions. And the strategies that haven't done as well, we top those up. And we do that quarter in, quarter out, so that in rising markets, we're always taking some of the profits off the table for you. And in falling markets, what that actually means is that if international shares have fallen heavily, and in the case of December 2018 and February, March 2020, international shares, Australian shares both fell quite significantly. And really what that saw us doing was, right at the time when many investors might feel fearful about selling conservative cash-based assets or fixed income assets, that's precisely what we did, because those strategies performed well compared to the other assets. So we trimmed those positions and topped up those strategies that had performed poorly in that period. And our clients were then able to participate more so in the rally than if we'd have only rebalanced on an annual basis.
And as you said, that was part of a consistent part of the strategy, and we're going to talk a little bit later about the investment philosophy and how that sort of fits into it. But that was, I guess, to both of your points, they're not something that was a new decision or something that was a active choice at the time. It was just part of the ongoing, consistent management of the portfolios. And I think you probably, I speak to clients about it, and sometimes it happens every quarter, and often it makes a small difference to managing risk as well as a small difference to performance. But in recent times with more volatility, it has potentially shown out, I guess, in a stronger, more immediate way.
I think that's very much, the new world, the new norm going forward is going to be that there will be increased volatility. We saw last year a lot more entrance into trading shares. I think ComSec, there was 4 or 5 times, the normal number of brokerage accounts opened. You've got the rise of ETFs, the rise of different thematics, the rise of more passive investing. And, for us, that actually presents opportunity in how we manage money alongside just buy and hold or buy and sell decisions or what's the right company. So there's a constant evolution in advice and managing portfolios. So there's, as long as the investment committee, we keep staying on top of it and getting expert guidance and input and having those robust conversations internally, we can really ensure that we never forget our first principle, which is, taking care of our clients. And that's certainly where our journey that we've been through today.
Yeah. So I think that's a good segue into, the next question I had was about, we have seen interesting times, economic and market circumstances off the back of, as you said, Hugh, the COVID cliff. I guess I'd be interested to explore, you said there's, the volatility creates opportunities. How do you see that, and what have you learnt over the recent times with the extra volatility, and what have you learnt? What does that mean for portfolios and clients looking forward?
Yep. Marsh, you want to go?
I'm more than happy to go on that. I guess from our viewpoint, when building the models, it's our role to allocate money to the different asset classes and to make sure that we're selecting managers that we've got really high confidence in, and to allow them the freedom to allocate money where they want to do so, and to not really, I guess, second guess some of those decisions. So in some time, I think one of the things Hugh touched on is, that there's quite a lot of new product coming into the market with exchange traded funds, a lot of providers wanting to ride certain, waves of momentum. And part of our role is, at times to say no to that and to make sure that we're doing the right things consistently. And if something looks interesting, you don't need to be first to market to adopt that approach, just to, take very seriously that role as being custodian, to take a step back and to act decisively when you need to. But if you don't need to act, sometimes the best decision is not to act.
I think that's part of our conversation has been, when we've talked about it, has been you don't have to swing at every pitch. So for us, you saw a lot of people will go into a new theme and it might not be the time to do it. So by having that experience and that rigor and robust process, we've seen it a number of times. So you think from the client perspective, they're only going to go down the garden path once. They're only going to have one retirement there. The amount of information they're going to get is very different to someone who's in and out of the trenches every day. So some of the things, that have emerged, we've already seen before, and we're aware that, that it's going to be very difficult for them to work. Some strategies are strategies that, came in vogue prior to the GFC, which we would never touch as an investment committee because we're never going to risk our clients' capital. That's part of the stuff when you've got ultra low interest rates, a lot of new product coming to market, is the ability to say no is sometimes just as important as the ability to say yes. So that's something that we're very, very strong about within our group.
I think that's a really interesting point you make about the low interest rates. I was in a meeting with a client just prior to jumping on the webinar and talking about the proliferation of products that are coming out, which are trying to, I guess, manufacture a yield or an income stream, and they're trying to position themselves as potentially, almost cash-like investments, but they're very different. They're very higher risk profile, and very different types of investments. And I think that's where, having the input and the, I guess, rigor of a process to be able to go through and investigate those products and work out where they fit, if they have a role, or if it's something that, as you said, you just let that one go past. And
I think that's part of the issue is though that there is a bit of fear mongering. You look at, I remember last year, when COVID was happening, the fear that they're putting into everyone about, protecting their money, and everything became very short-termism in thoughts. And you're looking at longevity-based products now that are looking at really low interest rates, possibly locking in really low interest rates. And you say, well, hang on, I know there's a lot of argument in our industry that the balanced fund is dead, but if we look at long-term performance, and all of our clients are long-term by nature, then we can kind of show that the proof is in the pudding, and they're not dead. And by prudent allocation, that's the strategy, and proactive management is the strategy. There's not a strategy that's set and forget nowadays. The world's just too dynamic. So I think with volatility and increased volatility, there's that rise and that need for someone to be there as the guardian or custodian. And I think that's here to stay nowadays, especially as you get, if we look at retiree clients, traditionally they would want to hold more cash and fixed interest, and that would make sense. But we've got to use certain strategies and structures so that they don't have to rely on holding too much cash, because that in itself is problematic in this current environment.
Yeah, and I think it's also a two-tiered approach. There's the hat that Hugh and I wear in building portfolios, or rather models, and maintaining them. But then there's also the hat that our client's individual advisor wears, and how they allocate money to cash buckets, how they allocate money to term deposits outside of the models, so that the client doesn't have too much cash in transaction accounts earning 0% interest. And on the flip side, they've also know that they've got a couple of years worth of spending there just in case markets do get a bit jittery, which they do, at least once a year.
Which you can't blame them for. Like, if you're looking at all the media and listen to your friend at the golf club and things like that, you would panic. And I think that's having a trusted advisor to be able to go call, email, and say, hey, hang on, we've heard this, what's the expert view on this? And that should hold a lot of weight. And hopefully after the last 12 months, what people see is that we were true, we did communicate, we were honest, that we didn't know what the world looked like, but we acted in an appropriate manner, and it worked out well. So the next time that it happens, which it will happen again, I don't know the day or time yet, but it will happen, and we'll face that challenge with the same approach that we did last time.
Yeah, I think it's really interesting that balance between it's not a set and forget portfolio, but it's not a constantly tinkering and making changes. It's having that consistent philosophy, but being able to act within those, I guess, in that framework at the right time. And one of the examples you mentioned, Hugh, was with hedging. So the decision to hedge, I guess, tinker with the hedging of the portfolio earlier last year. So maybe you could touch on that a little bit to just, I guess, give a little bit of flavour to actually how that work, how that changes in the portfolio works.
Mm-hmm. So effectively, everything's about protection. I'll let Marsh go on to the currency in more detail. And it was just great insight by managers, and thinking about we weren't just thinking about COVID, we're thinking about all the derivatives that came off managing money in that. And one of those things is, well, what are we going to do with our international exposure? I believe, Marsh, but correct me if I'm wrong, we were at that point all unhedged. And then the views of the investment committee were, well, what is this a position going forward? So if you want to go from there.
Yeah, so, last February, March, when markets fell, and there is often a high correlation between the volatility in global markets and how the Australian dollar behaves. So in this example, and it's been borne out time and time again, that when international markets fall, often the Australian dollar falls as well. And it fell reasonably heavily. It got down to about 57 or 58 US cents, I think it was. And at or around that time, we'd had numerous conversations at the investment committee level, and also with professional managers that we work with. And we implemented a solution where we hedged half of the portfolio. Now, the reason why we did that at the time was because, we were of the view that, once sanity returned to the markets and there was more certainty, the Australian dollar was most likely going to go back to or around its long-term averages, which is roughly where it is now. And as a result of that, our clients were able to participate in the upside. And depending on what time frame you look at, that added anywhere from sort of 3 to 6% to the portfolio performance. And it did lead to a lot of soul searching within the investment committee around building a framework that would see us deliver tactical steps like that when it was required. And you saw us unwind some of that hedging position in the last reweight, which meant that we're able to lock in some of the gain that our clients have experienced. And we now have a framework such that if it does fall back to that 58-cent level or thereabouts, that we've got the opportunity to make some of those tactical decisions again.
Excellent. Thanks for explaining that as an example of, as you said, some of the tactical responses. So I guess coming back to, what's been learned, are there any other lessons that have learned or anything else that the investment committee is keeping in mind, which we think will help us get through the next crash?
One thing I would flag is that whilst that was a tactical decision that we made about currency, those that sit on the investment committee have been building portfolios for about 20 years, and we've met many investment managers that every other week are making very, very small adjustments of 1% or 0.5%, and effectively you have a group of individuals in a boardroom making these very, 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 very small movements. And the key learning from our viewpoint is that you're better off allocating larger levels of capital, maintaining strategic allocations, and doing that quarterly rebalance rather than incurring fees, brokerage costs at a client level by making small adjustments.
I think that's the benefit of our investment committee is we always come back to the client. We think about what the impact is going to be on the client, not at the portfolio level. So the beauty of us all being advisors and seeing clients and understanding what the advisors within our office goes through has meant that we've never lost sight of that end goal. And if you look at why we've built our investment committee and our capabilities so that we can, get the scale to be able to get discounts from some of the best global managers there are, and we get some great benefits of the scaling discounts that we get to pass on to our clients, our global and Australian managers, I should say. We've then gone through the research, the process collectively. If there's 20 years between each of us, combined, that's a big number, and probably in excess of 100 years of experience, where we've all been on a journey. We've been through a few dips, a few crashes, and there's things that you do learn, and there's things that you learn to avoid as well. So, in our world, we've learned we don't need to be into everything. We can avoid unlisted assets to a point. We can avoid high yield products to a point. We can, in the portfolio sense, if people wanted to allocate that for specific purposes, okay, that's a consideration. But from our point of view, we've kept our core portfolios, these model portfolios, at what looks like a simple approach, but we can all remember Albert Einstein said, make things as simple as possible, but not simpler. So it looks simple, but when you hear this and you understand what the investment committee goes through, it's a really robust process, and that's been a really good thing for our clients to enjoy. And I think collectively we all agree the synergy has been that clients have got a better outcome from us having this approach, not just in terms of better returns, not just in terms of decreasing costs, but in an approach, in a philosophy that can work to their benefit. Yeah.
I think there was, one of the key lessons that we talk about from the GFC was there was a proliferation of really, overly financially engineered products and, gearing and illiquidity and that type of thing. And they were the ones that fared the worst out of, for retail investors. So there were some good lessons that we've taken out of that. And, I think you see from time to time, individual investors probably forgot some of those lessons pretty quickly. But with our, collective 100 years of experience on the investment committee, we keep that in mind.
Yeah, and I think that's just a massive value add, because you might not have gone down that garden path during the GFC either. So you didn't know. So when you see a high yield product today, and look at what was it, Platinum Mayfair, just recently that got a lot of clients involved in it and it went broke. So that was something where we would not have even entertained the thought, because we'd seen that song before. We knew how it ended. And unfortunately, there was a lot of people there who were unadvised, who made big mistakes. That was wholesale clients who typically people would assume would have a better knowledge, but they fell for, what's, a high yield marketing campaign, basically.
Yeah, I think one of the other key learnings over time is that when we typically build portfolios, we think about liquidity at all times. And compared to some of the other funds in our peer group over the last 12 months, which might have larger allocations to things like airports, railways, and infrastructure assets, typically they're not liquid strategies. And, when large numbers of investors wanting to redeem money throughout the year as a result of the COVID early release opportunities, it wasn't so easy for some of those funds to, sell off part of the airport or sell off part of the port. So we always make sure that our clients are able to access that capital if and when they need to. And I think that was a key learning, and that's why some of the numbers are as they are at the moment.
Yep. So we're going to move on to the talk about the investment philosophy shortly, but just want to encourage everybody playing along at home. If you do have any questions for Marshall and Hugh, then please type them in. So click on the Q&A tab down the bottom and type those in. We do have one question that's come through so far, and just touching on, you talked about, I guess I'll paraphrase the question, but you talked about market volatility. You talked about the importance of capital preservation and that being a big focus. A lot of, maybe not a lot, but many retail investors, individual investors might have looked at capital preservation and thought they're going to put their money in cash when markets fell off the COVID cliff. Was that discussed, or what was the conversation around that when that was the news, I guess, in the public?
I think this is something that we certainly talk about with all of our clients, and I think everyone should. Let's keep reminding them about this, how it felt during that time. They're watching the news, they're looking at everything, and they're ready to panic. And if we look historically at the markets, 1 in every 4 years in a share market is bad. In a balanced fund, it's probably about 1 every 6 or 7 years is negative. The inverse of that is 3 out of 4 are good in the share market. 6 out of 7 are good in a balanced fund. So let's remember the plan. Your individual advisor is going to have carved out, if you're a retiree, the cash, your pension requirements for the next couple of years. So you're going to be okay. Sometimes the investor's worst enemy is the mirror, and his or her mirror, and looking at that and learning that what we were saying to our clients is just switch off the TV. Don't look at it, because if you look at it every single day, you'll think that you need to do something, and do nothing is an approach, and it's investment strategy. So we'd always told our clients that there will be negative returns, but we just got to not panic. And for our accumulators, it was a great time to profit. The argument about converting to cash if interest rates were 5%, that's a thought. But again, if I know my long-term rate of return in the share market from 1950 is 10.7%, I'm not really going to look to sell down if I don't need to. And I think from our perspective, it's always, let's not fall victim to short-termism in thinking, and let's play the long game, because long-term investing, we know for everyone, works. And we've just got to stay on track to achieve those goals. That's the importance of everyone understanding what their goals are and what their purpose is of the investments too.
Right. So Hugh, keep going. Tell us about, AAN does have a very clear investment philosophy. So can you talk to us about, what that looks like and how that's been helpful and important over these interesting times?
So in terms of, do you want me to go to showing you anything? Showing you the website?
No, just give us
just talk to us. So in terms of our philosophy, we spent a long time. It probably took a good 6 months for us to really try and drill down to what's important to us at the investment level, what's important to us as a group, and what's important to our clients. And so this is going to be, these are principles from our point of view. So in terms of when we did it, we're looking at research, is paramount to what we do and what we want to achieve for clients. So spending a lot of time doing research, sticking to our discipline. So when Marsh was talking before about, sticking to the rebalancing when it was tough, sticking to the weighting that we have to Australian equities, international equities, cash, fixed interest, property, really hard at times to be disciplined. I think we all know that personally, perhaps in our gym commitments or other commitments to be good, it can be quite difficult at times to stay disciplined. And certainly when the markets are volatile is when we are most inclined to want to act. But again, we need to go back to what our principles are and what we know works, because over the long run, we know it will. The big thing for us has been avoiding the downside. So, we're not going to, if the market goes down, we're going to go down a little bit, but, trying to manage that downside risk is really important. In our world, we call that drawdown risk. And that's been paramount to us in when we're assessing managers that we want to put into our portfolios or even onto our bench. We're not really necessarily looking for the massive outperformance, because sometimes people can just take more risk to get a great return. And we want to avoid that. We're never going to gamble with our clients' money. So what we're looking at, capital preservation, and we all know that if you avoid losing money, it's easier to keep going forwards. And transparency would be important to in today's world with technology where it is. If you don't have transparency, if you can't see where your money is, we think there's a real issue with that. You should be able to know where your money is invested. I think people deserve that. And that was one of our issues that we had historically, was that people didn't know where their money was. They would just see one pie chart and that was it. So with a greater level of technology, and clients are getting more and more sophisticated, now they can understand. And that interacting means, and understanding where your money is, means that you might not panic as much when there is downside. But also it gives you a bit more interaction so that you are now more engaged and understanding where your money is invested and what's invested in. And I think maybe Marsh can touch on that. Where our clients are wanting to invest now is moving into more a sustainable side of things, which is really, really cool. And an evolution that we're obviously hearing from our clients and seeing in the world, and trying to build something that can make a positive difference with our client in mind and society. And being in that, because we are in everything that we do, we take a long-term time frame. We're not thinking 1 year, 2 year, 3 year. The fact that our returns that Marshall talked about before were sensational, we never thought that. We were just trying to protect money and make smart decisions. The outcomes took care of itself. We spend all the time on the inputs, and we're confident that if we do that, we're just going to help our clients achieve success. It's just that's the way that we see it fundamentally in terms of an investment approach.
Yeah, one thing I would add to that, Hugh, and you talked about potentially chasing those portfolios that have great outcomes or that great returns. It reminds me of the Warren Buffett adage that it's only when the tide goes out that you realise who's been swimming naked. And there are many investment managers that have wonderful performance in the good times, but then when the tide goes out, you really find out, what the underlying earnings are of the businesses that they're investing in, and you see a significant erosion in clients' capital. So that's something that's really important to us, that we understand that we're investing in sensible businesses with, proven cash flows, and we don't fall for the overly engineered exotic toy. And to Hugh's point around the sustainable piece, really, that's just about giving investors choices. And not all investors will want to go down that path, but even with our broad-based portfolios, clients can choose to exclude certain assets if they want to. And really, we're just trying to give clients choices and provide them with the very best guidance while doing so.
Excellent. And we've already seen some great take up since that sustainable growth model came into our, suite of options in December. So Marsh, we've talked about, you and Hugh as members of the AAN Investment Committee. So can you maybe talk a little bit more about, how does the AAN Investment Committee work? What are they responsible for? Who's involved? And that sort of thing. And then we'll finish off with Hugh giving us a bit of a demo of the new AAN asset management website.
Sounds good. So there are five firms that form AAN, and there's a member representative from each firm. Essentially that means there are 5 members of the investment committee that, between them would each have, about 20 years of experience in dealing with clients, but also building portfolios. In addition to that, we have an independent consultant that sits on the investment committee, and it's up to the 6 of us effectively to build, monitor and maintain the models. And we do that, we meet once per month. Throughout periods of heightened volatility, we were meeting sort of every 2 to 3 days or once a week. But broadly speaking, in terms of a maintenance protocol for the models, we meet each of the managers in the models on a quarterly basis. We meet each of the reserve bench managers for the models on a 6-monthly basis. And outside of that, we share the load in meeting other investment managers that are on our broader approved product list on an annual basis.
Yeah, we're always scanning. We're always looking.
Always looking, and outside of the the ongoing maintenance, there's always a series of projects that we will have up and running. So over the last 12 months, some of the projects would have included a formal review of international fixed income with interest rates where they are in the cycle, looking at how we can best protect our clients' money there. Formalizing the currency position and creating a framework going forward for that. Another example would have been the 12-month build of the sustainable portfolio. So there's always things outside of our role as advisors and outside of our role of the investment committee members to adhere to all of the different projects that you would expect to deliver good outcomes going forward.
Well, even the point about what we did with fixed interest, I think, where a lot of people talk about equities as risk, but during the year we went short duration. I know it's a bit technical, but we went short duration on our fixed interest assets. So if interest rates do rise, clients aren't going to lose capital value in the fixed interest side of things. So we're not just looking at the entertaining stuff, we're doing the hard stuff as well. And that's a massive value add to people that's happening in the background. That a lot wouldn't look at or know about, and it's not their job to. Like, that's our job. But they're the things that make me proud of what we're trying to achieve for clients, is that we're looking for that extra element of managing risk, and we stick together on those things, and we all understood it. And no matter what happens now, we know our clients are well positioned. So because we don't know when the next crash is going to happen, but if it does happen in fixed interest, our clients are better protected than if they're in solutions that a lot of other people are just sitting in thinking that it's a safe asset.
Yeah. And so just to clarify on your point, Marsh, about reserve bench managers and talking to the managers that are in the portfolio. So the investment committee is really keeping in touch with specialists who have expertise in particular sectors or particular asset classes in the market. The investment committee sort of frames within that philosophy how the assets should be allocated, and then chooses particular managers to give a portion of that asset classes allocation to. And so always having people on the reserve bench in case something changes, in case a manager drops the ball, that's a really important part of the process as well.
Yeah, correct. So one example of that would have been several years ago, we had an allocation to a firm called the Macquarie High Conviction Fund. And an example where someone might be replaced, in that sense, their entire team walked out to set up their own fund. And, the current model management framework was that we had a reserve bench, a reserve manager in place, and we were able to replace Macquarie with Bennelong effectively within 24 hours, which it gave us a lot of comfort knowing that we'd researched alternative providers and we had a suitable replacement there ready to go, and we were able to slot them in very quickly.
Yeah, thanks. That's a great example. So just as we close off, Hugh, I know you've spent one of your projects on the investment committee has been driving the development of a new website for AAN Asset Management, which has recently gone live. And for those following the socials of AAN and Evalesco and Centaur and the other businesses, you might have seen some promotion of this, but we'd love for you to be able to share some of your handiwork. And so show our clients at home where they can go, some of the tools and what they might enjoy being able to access on the website.
Okay, can you guys see this?
Yes, thank you.
So this is the AAN Asset Management website. If you go to AAN AM, so that's Australian Advice Network Asset Management.com.au. The philosophy behind this was to provide our clients with something where they can see, everything about us outside of their portfolio, just to get a bit more confidence in what we're doing. So we've worked hard behind the scenes, and we'd welcome any feedback, just going through what's important, what's the benefits of our model, what are our returns, so that you can get a comparison to maybe what your friends have done, etc. We've only got till March 31st here, but that will be uploaded soon to June 30. And then what we can do here is we can click into our investment options. If we want to see them, it will take us across to looking at, what the performance has been like for a short period, a longer period, what our top 5 holdings are. So again, it goes to our point of transparency and understanding the purpose of the fund. So if you think, well, hang on, where is my money allocated? Well, if you're in the core fund, you can see that 65% of your money is in growth assets. Probably more important than even just the investment models to me is really going through here. And if you want to know about us as AAN Asset Management, talking about our investment committee, there's some mug shots here, but it's nice to be able to understand who it is that's behind the scenes helping you manage your life savings. So that was part of the thesis for us in building this, that you can really look through and understand. We've got the about us that we can then go and see what's the philosophy. So we know Jeff asked me before and we touched on it. Our mission is to provide quality investment solutions that make a positive, meaningful difference in our clients' lives. So we can see that we're grounded in research, discipline, positive returns while managing the downside risk. We believe in transparency, and anyone that's through the premium portfolio will know that when they log in there, there really is the feedback from our clients has been amazing in terms of the level of transparency relative to what they might have had previously. We're long-term investors. The investments that we're making for our clients are in their best interests, working towards their goal. We're not going to suffer from short-term thinking. That's the great ability from having a group. And our focus is always on our clients and you clients achieving your successes. And we believe that, passionately, that your success is our success. From there, the growth in what clients have been wanting and asking for has been about building a sustainable investment. So we've got that in the growth model. And this is really important to us, that when you're investing, you can understand where it's invested. It's not just going to go into a sustainable fund, which may not truly be a sustainable fund. So here you can look at it and go through and see how we actually select managers, how we review them. And then we can go back onto our investment models to see that. So again, we know that it's been in force since December, but we can see the managers, we can see here, and what is, pretty interesting is we can see our returns over time. So this isn't something you need a login to do. You can go in and do that yourself. If we look at something with a longer term track record, you could log in here quickly with your mates after golf and say, hey, how's your stuff done? And you can compare us to the benchmark and see that your money's doing quite well relative to benchmark and also in real terms. We then have an area for helpful tools. This is nice for a clarification piece. If you are worried about markets, you can go in and look through there and really get some in-depth information. Market crashes, opens up in a new page. Okay, what would happen when the global financial crisis hit? You can see that it took you 5 years, 10 months to make your money back. So when we're designing our portfolios as at the advisor level, we're considering that. Then we've got, and then just our news. So if you look at the news, this is something that we're going to update more and more as we get more and more information. So just something where you can go to as a point of reference for more information. And in a quick 2 minutes, that's our website that we've built. Hopefully our clients will get some use out of it, and hopefully you can see it in some meetings with your advisors.
Thanks, Hugh. Great work. So I guess just to build on that, if you have specific questions that are relevant to your strategies, then speak to your advisor about that. If you're looking for some high level information, then that website's a great source of that sort of information, and can also then trigger some more conversations or some questions for your advisor or the investment committee to follow through on. So that perfect timing. We're right on 1:15, which was our designated finish time. So well done, guys, on keeping us on track. Thank you very much both for your contribution today, and thank you to you and the rest of the AAN Investment Committee for your fantastic work on behalf of our clients and our team over the last several years. Keep up the good work.
Easy.
Thanks, Jeff.
And for everybody at home, thanks very much for coming along today. If you do have any questions, please do get in touch with your advisor. But hopefully you're walking away knowing a little bit more about how the AAN investment models work, and feeling confident that the performance over the last 12 and 18 months, 2 years has been fantastic, but they really are designed to continue to perform through volatile markets and the inevitable future crashes that happen in markets. So thank you and have a great day.
Thank you very much. Bye.
Bye, everybody.